If you freelanced last year and pulled in $80,000 of profit, there's a line on your tax return that could quietly knock $16,000 off the income the IRS taxes you on. 16 grand, gone, and the wild part. The IRS itself reported that in the most recent year of published data, more than 25.6 million returns claimed this deduction, totaling over $205 billion, and yet I still talk to freelancers every single week who either skipped it, lowballed it, or let their software calculate it wrong and never checked. That's a real number from the IRS statistics of income, by the way, not something I made up to scare you. The deduction is called QBI, Qualified Business Income, and it lives in Section 199A of the tax code. It's the closest thing self-employed people have to a built-in raise, and the mistake I see most often isn't failing to claim it. It's claiming the wrong amount because nobody ever explained the formula in plain English. So that's what we're doing right now, the actual math, the income thresholds for this filing year, the trap that hits service businesses hardest, and the one move that can rescue the deduction if you're phasing out of it. Stick with me, because the dollar figures at the higher income levels get genuinely uncomfortable. Let's back up for a second on where this thing even came from, because it helps the rest make sense. QBI showed up in the Tax Cuts and Jobs Act of 2017. C corporations got their tax rate slashed from 35% down to a flat 21% permanent. Pass-through businesses, which is basically every freelancer, sole prop, single-member LLC, S-Corp, and partnership in America, got nothing from that rate cut directly. So Congress bolted on Section 199A as the consolation prize, a 20% deduction on qualified business income, to try and keep pass-throughs roughly competitive with C-Corp. It was scheduled to sunset at the end of 2025, which had every freelancer I know panicking last spring. But the One Big Beautiful Bill Act signed in July 2025 made the QBI deduction permanent. So this isn't a use-it-before-it-expires situation anymore. It's just part of the code now. Good news, finally. Okay, the mechanics. QBI is, at its simplest, 20% off the net profit from your freelance business, the number that lands on your Schedule C after expenses, minus a couple of small adjustments. Take a freelance graphic designer who invoices $90,000 for the year and has $20,000 of legitimate business expenses. Net profit, $70,000. Now, before QBI even enters the picture, she owes self-employment tax on that, about 15.3% on 92.35% of the profit, which the IRS lets her deduct half of above the line. That deductible half of SC tax is roughly $4,900 in her case, and it actually reduces her QBI slightly. Same with any contributions to a SCP IRA or solo 401(k) and any self-employed health insurance she deducts. All three of those come off the top before the 20% gets applied. People miss this constantly and overstate their QBI. So her real QBI is closer to $65,000 once you back those out, and 20% of $65,000 is $13,000. That's the deduction. If she's in the 22% federal bracket, $13,000 times 22% is about $2,860 of actual cash tax savings. Not a credit, a deduction, but real money she keeps. And here's the part I want you to internalize. QBI does not reduce your self-employment tax. It only reduces income tax. So when you're estimating quarterlies, do not subtract QBI from the number you base your SC tax on. I've watched people underpay by thousands doing that. Now here's where it gets interesting, and where most of the YouTube explainers I've seen just wave their hands. There are income thresholds, and they change everything. For the 2025 tax year, the taxable income threshold, where QBI starts phasing out, is $197,300 for single filers and $394,600 for married filing jointly. Those numbers come straight from the IRS revenue procedure that set inflation adjustments for 2025. Below those thresholds, the math is the simple version I just walked through, 20% of QBI, done, no further questions. Above them, the IRS starts asking what kind of business you run, and the answer can cost you the entire deduction. The category that gets hammered is what the code calls a specified service trade or business, SSTB for short, and the list is broad: health, law, accounting, consulting, financial services, performing arts, athletics, and the catch, all that nails most freelancers. Any trade or business where the principal asset is the reputation or skill of one or more of its employees. That last clause is the one that pulls in coaches, freelance consultants, brand strategists, fractional CMOs, voiceover artists, and a lot of solo creators. If your taxable income is over the threshold and you're an SSTB, the deduction starts phasing out, and it fully disappears at $247,300 single or $494,600 joint. Above that, an SSTB freelancer gets 0 QBI. That's the cliff, and it sneaks up on people who had a breakout year. Non-SSDBs think a freelance web developer, an e-commerce seller, a graphic designer who's selling templates, a videographer doing wedding work get treated more gently above the threshold. They don't lose the deduction. Instead, the calculation switches to a wage and property test. Your deduction becomes the lesser of 20% of QBI, or the greater of 50% of W-2 wages you paid, or 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. If you're a true solo freelancer with no employees and no big equipment, those wage numbers are 0, which means above the threshold your deduction can collapse even if you're not an SSTB. This is the part the software won't warn you about loudly enough. So what do you do if you're climbing toward those thresholds? Here's where my opinion gets pretty firm. The single best lever a high-earning freelancer has to preserve QBI is retirement contributions, and specifically a solo 401k. And this is the drum I've been beating for years. Most freelancers set up a solo 401k too late, usually the year after they needed it. A solo 401k in 2025 lets you contribute up to $23,500 as an employee, plus an employer profit-sharing piece, with a combined cap of $70,000 according to the IRS contribution limit notice for this year. Every dollar you put in pre-tax reduces your taxable income, which can pull you back under the QBI phase-out threshold and rescue the full 20% deduction. So the contribution doesn't just save you the marginal tax on the contribution itself, it can save you the entire QBI deduction on top. That's a double benefit most people never calculate. Quick worked example so you can see it. Say you're single, you had a great year, taxable income is sitting at $215,000, and you're a freelance consultant, which makes you an SSTB. You're $17,700 over the threshold of $197,300, deep into the phase-in range, and your QBI deduction is partially gutted. Drop $23,500 into a solo 401k as the employee deferral. Now your taxable income is $191,500, below the threshold, and your full QBI deduction is restored. The tax savings stack. You avoid tax on the $23,500 contribution at your marginal rate, and you reclaim a QBI deduction that was being clawed back. In a real scenario I sketched out for a friend last year, the combined effect was something like $11,000 in federal tax saved from a single move. Obviously, your bracket and your exact QBI math will shift those numbers, but the structural logic holds for anyone in that income band. Couple of edge cases I want to flag because they trip people up every filing season. First, rental real estate. The IRS has a safe harbor, Revenue Procedure 2019-38, that lets some rental activity qualify as a trade or business for QBI purposes, but you need 250 hours of rental services per year in separate books. And most casual landlords don't clear that bar. Don't just assume your rental income gets the 20%. Second, if you have multiple businesses, the calculation runs per business and then aggregates, and a loss in one can wipe out QBI in another. Third, and this one's a quiet killer, capital gains, dividends, and interest are not qualified business income, even if they show up on a K1. Reasonable comp paid to yourself out of an S-Corp is also excluded from QBI, which is why the S-Corp salary number you choose has direct consequences for this deduction. Pay yourself too much, you shrink QBI. Pay yourself too little, the IRS comes knocking on reasonable compensation grounds. There's a sweet spot, and it's a real planning conversation. One more thing I want to clear up because I hear it constantly. People confuse the QBI deduction with the standard deduction. They are completely separate. You take the standard deduction, or itemize, and then on top of that you take QBI. It lives on its own line, currently line 13 of Form 1040, and it's calculated on Form 8995 if you're under the threshold or Form 8995A if you're over it. The IRS reported in the most recent SOI data that the average QBI deduction claimed was just over $8,000 per return. If yours is dramatically lower than that and you're a profitable freelancer, something in your filing is probably wrong. Pull last year's return tonight and look at line 13. If it's blank or suspiciously small, that's your homework. I focus on the financial side of freelance and gig work. And honestly, QBI is the deduction I think gets botched more than any other on freelancer returns, not because it's complicated, but because tax software asks one or two questions and then quietly calculates a number you never sanity check. Don't let your software be the last word on a deduction this big. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this cleared things up, hit subscribe. I post a new freelance tax and money video every other day, and the playlist this belongs to walks through the deductions that actually move the needle. If there's a specific freelance tax question you want me to break down next, S-Corp election math, the home office deduction, quarterly estimates, whatever's nagging at you, drop it in the comments, and I'll work it into an upcoming video. And the tax software I personally use to model these scenarios before filing is linked below if you want to check it out. This video may contain affiliate links. I only recommend tools I use personally. Subscribe so you don't miss the next one.